Secrets that could cost you thousands of dollars over your lifetime. Today, we're going to uncover 5 truths about money that banks would rather you never discover. These aren't conspiracy theories or wild claims. These are facts backed by financial experts and industry insiders. By the end of this video, you'll see your bank account in a completely different light. And you'll know exactly how to protect your hard-earned money. Main content truth number 1. Your savings account is making you poorer right now. Most banks offer savings account interest rates between 0.01% and 0.5%. Meanwhile, inflation is running at around 3% to 4% annually. This means your money is losing value every single day it sits in that savings account. Let me give you a real example. If you have $10,000 in a typical savings account earning 0.1% interest, after 1 year you'll have $10,010. But with 3% inflation, you'd need $10,300 to buy the same things you could buy today. So you're actually losing $290 in purchasing power. Banks use your deposits to make loans at much higher interest rates, sometimes 15% to 25% for credit cards. They're making money off your money while paying you almost nothing in return. Truth number 2. Credit scores are designed to keep you borrowing. Banks want you to think that carrying a small balance on your credit cards helps your credit score. This is completely false. The credit scoring system is designed to reward consistent borrowing and payments, not responsible saving. Think about it this way. Someone who pays off the credit card in full every month and never borrows money will have a lower credit score than someone who maintains small balances and makes minimum payments. The system rewards debt, not financial responsibility. Credit bureaus make money when lenders check your credit, so they have an incentive to keep you in the borrowing cycle. The best credit scores come from having multiple types of credit accounts that you manage responsibly. But you don't need to pay interest to build good credit. You can pay your balance in full every month and still build an excellent credit score. Truth number 3. Overdraft fees are pure profit. Banks collected over $15 billion in overdraft fees last year alone. These fees often cost $35 for transactions as small as $5. Let's say you buy a coffee for $4.50, but you only have $4 in your account. The bank will approve the transaction and charge you a $35 overdraft fee. That's a 700% fee on a $5 transaction. Banks process transactions in specific orders to maximize overdraft fees. They often process larger transactions first, which depletes your account faster and creates more overdraft situations. Here's what most people don't know. You can opt out of overdraft protection entirely. If you opt out, your card will simply be declined when you don't have enough money. No fees, no surprises. But banks don't advertise this option because overdraft fees are incredibly profitable for them. Truth number 4. Banks make money when you don't understand compound interest. Albert Einstein supposedly called compound interest the 8th wonder of the world. Those who understand it earn it, those who don't pay it. Banks hope you fall into the second category. When you carry credit card debt, you're paying compound interest. A $5,000 credit card balance at 18% interest, paying only the minimum payment, will take you over 30 years to pay off. You'll end up paying more than $11,000 in interest alone. That same $5,000 invested in a simple index fund averaging 7% annual returns would grow to over $40,000 in 30 years. Banks profit enormously from people who don't understand this concept. They want you to focus on minimum payments, not the total cost of your debt. Truth number 5. Banks use your money to make money, but don't share the profits. When you deposit money in a bank, you're essentially giving them a loan. They use your deposits to make loans to other customers at much higher interest rates. A bank might pay you 0.1% on your savings account, then lend that same money to someone else at 7% for a mortgage. They keep the 6.9% difference as profit. Banks also invest your deposits in various financial instruments to generate returns. But you only get that tiny interest rate, regardless of how much profit they make from your money. This is why wealthy people don't keep large amounts of money in regular bank accounts. They understand that banks are using their money to create wealth, but they're not sharing those profits. Instead, wealthy individuals invest in stocks, bonds, real estate, and other assets that provide better returns. What you can do about it: first, shop around for high-yield savings accounts that offer better interest rates. Online banks often offer rates 10 to 20 times higher than traditional banks. Second, learn about investing in low-cost index funds for long-term growth. Even a 4% to 6% annual return is significantly better than most savings accounts. Third, always pay your credit card balances in full to avoid interest charges. Fourth, opt out of overdraft protection to avoid those expensive fees. Finally, educate yourself about personal finance and investing. The more you know, the less banks can profit from your ignorance. These 5 truths might be uncomfortable, but knowledge is power. Banks aren't evil, but they are businesses designed to make profit. The more you understand how they operate, the better you can protect and grow your wealth. If this video opened your eyes to something new, hit that like button. Share it with someone who needs to hear these truths. And subscribe for more content that puts your financial interests first. What surprised you most about these banking truths? Drop a comment below and let's start a conversation. Remember, your financial future is in your hands, not your bank's.